The market is expensive and as concentrated as it's ever been, and that's likely to change our investment landscape going forward. Here's why. This is me 1 year ago, warning a group of advisors that the market was likely running out of steam. See, at the time, the market was inching closer and closer to dot-com level valuations. The top 10 stocks made up 36% of the index. Concentration was inching closer to levels not seen in over a century. Small caps had been beaten to death, continuing their relative underperformance to large caps since 2016. The writing was on the wall. To be fair, it had been there for a while. But maybe it was finally time for US large caps to catch a break. Well, that didn't happen. What followed could not have been any more different to my warning. Large caps went on to absolutely crush. Investor sentiment kept expanding valuations while the index kept concentrating more and more. So what happened here? Was I wrong in my thinking, or are we all actually kind of doomed and the market is about to fundamentally change going forward?
You know, Don, sometimes I sit here and worry why I have any money in stocks whatsoever.
I think if you look at some prices, then they're elevated relative to historical levels.
All this means is markets are expensive.
But how do we know when irrational exuberance has unduly escalated asset values?
There's a season for everything in investing.
And this is not some bold prediction. This is just a historical perspective. This episode is sponsored by Alpha Architect ETFs, but more on that later. Morning. So before starting, I wanted to give you a quick picture of where we are today in the market. And I think this will give us an understanding of where the market is potentially heading. So the first thing I wanted to look at is concentration. So currently the top 10 holdings in the market make up 38.94% of the index. Now we can call that 39%, but as you may know, Google has two share classes in the top 10. So if we did the top 11 stocks, which really is the top 10 companies, that concentration quickly rises to 40.42%. We can call that 40%. Last year, when this idiot was talking to advisors, that number was 36%. So it rose a good amount. Get this though, prior to this year, market concentration had a historical high of 38% in the 1900s. So today we're as concentrated as we've ever been in history. Just from last year to this year, we are now at all-time highs in concentration. The second thing I wanted to look at is valuation. Last year, the CAPE ratio was at a reading of 35.8. And if you don't know what the CAPE ratio is, think about it as a P ratio for the market as a whole. The one difference is that it smooths earnings as to account for some of the booms and busts in the economy. And today, that reading is slightly above 40. The last time this happened was in, you guessed it, the late 90s. Even post-COVID valuations pale in comparison. So I hope that today we can agree on at least two things. First, the market is as concentrated as it's ever been. And second, valuations are historically high, en route to surpass even dot-com level valuations. And I know what you might be thinking. Why should I care about this? I mean, some of the top names in the index are really special names. So what's this whole fuss about? Well, maybe we should talk to someone about this. Yeah, let's go talk to someone. I'll go ahead and just, if you're good with it, let's just get into it and ask the first question. Yeah, man. Meb Faber is the founder and chief investment officer at Cambria Investments. A writer and frequent speaker, Meb has spent the past 10 years leading the charge in educating investors on how valuations have driven market outcomes throughout history, and what that may mean for investors in this day and age. Famously, 11 years ago, Meb went on Google Talks to warn investors about the dangers of overvaluation in stock markets.
The more expensive you pay for stocks, the worse the future returns are. The less you pay for them, the better the future returns are.
This talk had a personal impact on how I view the role of valuation and diversification in investing.
The funny part about giving that talk at Google, this is 10, 11 years ago, like you mentioned. If you look at where we are now, we're at a value of around 26. So unfortunately, in the worst bucket, where the red line is right now, where future returns should be pretty muted, pretty low. We don't think it's a bubble, it's not crazy. Diagnosis was a little bit expensive. Diagnosis today is a lot bit expensive, right? It's taken out every other valuation peak with the exception of the final boss December 1999.
And it's my job to make animals happy. Pets.com, because pets can't drive.
But the 10-year PE ratio, the historical average is like 18. In low inflationary times, the historical average is around 22, maybe 23. Most of the time, it hangs out around 20. There's only been a handful of times when countries have ended the year above 40. We're not there yet. We haven't ended the year above 40. Historical average returns for the next 10 years on a real basis are 0. And not once ever have the historical returns been above average. So above, say, 6% real, 10% nominal, okay? So not good starting point, but it could happen. Look, the BRICS were in the 50s, India and China in 2007, Japan hit almost 100. All this means is markets are expensive.
With a CAPE ratio above 40 and MEB's claims that no market above a CAPE of 40 by the end of the year has ever achieved positive returns 10 years later, I wanted to run the data myself and see what I could find. This is truly astonishing. So here you have the Shiller CAPE in black going back to 1881. When the line is going up, what this means is that the market is getting more expensive. So not necessarily improving in fundamentals, it just means that people are willing to pay more for the same company earnings. What's more astonishing is the green line, which represents the compounded rate the market earned 10 years later on a real basis. So for every black point in this graph, there is a corresponding level of realized returns, and this ends in 2015 because, well, it's 2025 and we don't have foresight as to what's going to happen in the future. But visually, you can clearly see that there is a historical negative relationship between valuations and future returns. When the market is expensive, returns tend to be pretty muted going forward, but when the market is cheap, it tends to have better than average returns. In fact, if we used a simple linear regression, we could extrapolate that the market is looking like it will compound at a real rate of negative 2.46% per year for the next 10 years. Again, this is a model, so not an exact science, but last time we were at a CAPE ratio similar to what we're at today, and that was during the dot-com bubble, the market went on to lose a compounded rate of negative 2.11% per year for the next 10 years. And if you think that can't happen because things look pretty good now, remember, things looked pretty good back then too.
Everything always looks amazing at market peaks, right? That's the euphoria period. Guess when, in the history of the sentiment surveys, people were most bullish on stocks? December 1999, the literal worst month in my lifetime to be bullish stocks. They got it exactly wrong, right? So people were most excited when things have gone up the most already. And when were they most bearish? You know what I'm going to say, March 2009.
Uncertain how much lower stocks might go, investors have retreated to the sidelines.
I mean, hey, look, we just had a Fed governor say the market's expensive. I don't think we've had that since old Allen said it in the 90s.
I think if you look at some prices, then they're elevated relative to historical levels.
The Achilles heel of indexing. And when I say indexing, I mean one thing only, and one thing only is market cap weighted indexing. It's a great way to invest most of the time, except when things go into full bubble mode, which above 40 PE is full bubble mode. So picture Japan, the world's largest stock market in the 1980s. Their market had gone up so much, almost at a P ratio of 100. So as an indexer, you put most of your money in Japan at the exact peak of when it was the most expensive and went nowhere for 30 years.
Spending 30 years underwater is likely an effect of extreme overvaluation. And while the US market today is nowhere near those levels, if the future looks like the past, we're in for a ride. But that's just the thing. The future would have to look like the past, whereas currently these tech stocks that make up a good chunk of the index actually look like great companies. And that brings me to the topic of concentration. Currently, about 40% of the US market is concentrated in 10 holdings. And yet, it's not like these companies are complete garbage. In fact, Michael Mauboussin and Dan Callahan famously wrote a paper in 2023 evaluating this very topic. In it, they estimate that, and I quote here, the aggregate economic profit for the US public companies in our universe was $481 billion, and that the top 10 companies by market capitalization contributed $331 billion to that total. So while at the time, the top 10 holdings were 27% of the index, they had accounted for roughly 69% of the impact for the market. While in theory, stocks that are considered this safe should yield lower returns going forward, I think the real question to ask is this time different? But before answering that question, I wanted to introduce the sponsor for today's video, and that is us. Yes, we're more than content creators. Alpha Architect is an asset management firm that focuses on delivering affordable alpha to our clients. Our lineup of ETFs seek to deliver high conviction, highly differentiated strategies for investors and advisors. If you'd like to know more about our offerings, head to funds.alphaarchitect.com. Back to the video.
One of the worst ways to invest is buying the biggest company. Going forward for the next decade, they usually underperform by about 3 percentage points per year for a decade. So that's a lot.
Mauboussin and Callahan found the same. By investing in the largest stock, investors would have lost negative 4.3% compounded relative to the index since 1950. But is concentration really all that bad? Well, not necessarily. It just depends on what happens to the index going forward. So think about it like this. When you own anything out of proportion relative to the global market portfolio, you are hoping that those assets go up. No doubt. If you own a concentrated portfolio, you are hoping that concentration rises because by its very nature, that means your largest holdings are outperforming the rest of your portfolio. And historically, this has been true. In periods of rising concentration, the market tends to do better. But when concentration is falling, returns are not necessarily negative, but they're definitely much more muted. In the words of the authors, it is a tautology to say that stock market concentration has increased because the stocks of large cap stocks have done well, that trees do not grow to the sky, and acknowledgement that there is a limit to growth in size would suggest caution. What's so crazy about this paper is that it was written only 2 years ago. Back then, Mauboussin and Callahan were talking about the top 10 holdings making up 27% of the index. Today, we're in the 40s. Not to mention, the top 10 holdings have an average PE ratio of 56. That level of concentration and the speed at which it has concentrated should be a concern for investors. The higher the concentration and the valuation, the more likely mean reversion is to follow. So, where do we go from here? What should investors do with this information?
The biggest takeaway from all of what we're talking about, there's a season for everything in investing. There's a season for large versus small, value versus growth, gold, on and on. All these things, and even Bogle himself, the king of never market time, talks about this in a YouTube video where he says he moved his allocation in the late 90s away from really expensive markets into things that are cheaper.
Reducing my own equity position from it's normal of about 70, 75% down to about 25 or 30%. And I did that.
You could do a lot of things. You could say, you know what? I'm going to move away from the expensive stocks to the cheaper stocks. You could say, I'm going to move away from the large caps to mid or small cap. I'm going to move away from the US to foreign to emerging. I'm going to move away from US stocks to bonds, to REITs, to precious metals. And lastly, if you're totally crazy, active approaches like trend following, the ultimate diversifier to a traditional buy and hold portfolio. And simply, of course, rebalancing is one that will take you keep you honest too.
Fishing in the same pond of US mega cap stocks is likely not the most appealing proposition going forward. And this is not some bold prediction, this is just a historical perspective. Having said that, using valuations to time the market is also a very finicky proposition at best. But it's not like you have to market time at all. By just tilting towards smaller and cheaper stocks both here and abroad, you could potentially dampen the effects of concentration and valuation. Not to mention adding other asset classes and strategies like trend following. So what do you think? Are we in for the ride of our lives, or is this time truly and actually different? Let me know what you think down below. Thank you for watching. If you enjoyed this video, make sure to like and subscribe, but more importantly, share this video with a friend.